Namaste, welcome to Arthaniti. It is again that time of the year when we have to complete our tax saving investments before the end of the financial year. Have you invested in ELSS, equity linked saving schemes, or are you still averse to investing in mutual funds? Well, even though mutual fund portfolios and assets under management of mutual funds is on an increase, overall the penetration of mutual funds as an investment product in India is very, very low compared to other investment products. One primary reason that people responded to my questionnaire when I was pursuing my PhD, pursuing my doctoral studies, was that they did not understand the product and they thought the product was very, very complicated. And that was one primary reason why they stayed away from investing in a mutual fund. Now, mutual funds, so to say, are a very easy product to understand. I am here to help you pass that barrier and look at mutual funds as a convenient investment option which will give you better returns than most of the fixed interest earning securities that you are earning right now. Now, all of us know that mutual fund is a pool of money where people like you, me, and a few others collect small amounts of money and a corpus is built, which is then professionally managed by the fund manager with the help of a research team that is employed in the mutual fund house. Now, there are various kinds of mutual funds. I will talk about and explain each of the various kinds in my videos. So keep on watching my channel. Right now, before we go on to the different types of mutual funds, and who can invest in those types. First, let us start from the very basic. What are the steps that a new investors who want to invest in a mutual fund for the first time, what are the steps that he has to take? What is it that he has to understand before he decides to put his money in a mutual fund? Now, before we go on to the steps, here are some points that I want you to think about. Before the reason that you should invest mutual funds as a part of your investment portfolio. Now, investing in mutual funds is convenient. Why? Because it is you give your money to a fund house who is working under the auspices of SEBI. So this is not any private company wherein there is no recourse in case of a problem. So SEBI is very much in control of what is happening with the fund houses, and so there is ease of transaction, there is convenience. Secondly, there is professional management. Right now, on a day-to-day basis, you and me will not be able to track what is happening in the stock market, in the commodities market. Like, for example, if you heard the news that yesterday nickel is one of the important components in the batteries used in electric vehicles. Now, all of us know that petrol and diesel is going to get dearer because of this Ukraine and Russia conflict, and switching to alternate sources of energy for our transportation is going to be the future. But nickel, which is one of the important components in EV batteries, also rose to such a level that the trading had to be stopped. Now, as like we are so busy in our daily lives, such news, or it is not possible for us to keep track of each and every news and then decide which is the best investment strategy to follow. So you appoint a professional, you appoint an expert whose only job is to track what is happening in the market. So he is going to work on your behalf and he is going to invest your funds. So professional management, convenience. The third thing is, since it is not only for my or your particular fund, but a group of people like us who chip in their money, the risk automatically gets diversified. The risk automatically gets distributed amongst all the unit holders in the mutual fund. Right. So that is also one major advantage. You can invest in ELSS schemes, equity linked savings schemes, who have a lock in period of 3 years up to 1,50,000 rupees and earn better returns than most of the tax saving products available in the market. So never ignore this particular aspect when you are thinking of tax saving investments. Now, going on to what steps you need to follow before you start investing in a mutual fund, we will look at it in this next chapter. First thing that you should think about before you start investing in a mutual fund, like any other investment, is your financial and investment goal. Now, financial goal says if you have newly started earning money, your financial goals, you need to build a corpus, say to buy a house of your own, to buy a vehicle for a holiday, or some expensive electronic gadget that you want to buy. Your financial goals can be any. Goals need to be divided into short, medium and long term. So your retirement also should be on your mind once you start investing money. Why is this necessary? This is necessary so that you know the time duration that you want your money to be invested in, and it also helps you profile your risk taking ability. Now this ability to take or digest risk is different for different person, so it is not same for all, correct? Now, how much risk I can take will depend on my emotional background or the circumstances through which I have risen in life, and that defines my risk taking ability. So there is no harm if you it will not be such that if your risk taking capacity is less, your investment returns will be on a lower side, and if your risk taking capacity is high, you will earn higher returns on your investment. It is not the case. It is the case of understanding your digestion capacity for the risk or loss of value in your investment if you opt for a high risk investment option, say like stock markets and equities. Correct? So if you are averse to that kind of a risk, you still have other instruments wherein you can earn a healthy return on your investments and have your peace of mind. Ultimately, peace of mind is what we are looking at when we earn money, right? So never ignore your capacity, never ignore what your heart and mind tells you, and the threshold beyond which your risk taking capacity will not go. So this is a very important first step when you start your investment journey in a mutual fund. Think about your financial goals, think of the time duration and the risk taking appetite that you have. Now, the second step in your process of investing in a mutual fund is deciding the right scheme for you, right? Now, there are more than 45 registered mutual fund houses in India and more than 2,500 schemes running in the country. So, out of these 2,500 schemes, which is the scheme that is right for me? Very difficult to choose. Are you going to read through the materials of all the 2,500 schemes and then decide which is the best one for you? Confusion is all you will get at the end of your reading. See, when I said that setting your financial goals, what happens is you automatically limit of the 2,500 schemes which suit your goal, time duration and risk taking capacity. So that many are already discounted of the total 2,500 schemes that are available in the market. Deciding the right mutual fund again will help you decide on the kind of returns that you can expect from your investments. So the second step in your journey to investing in a mutual fund is zeroing in on the right kind of mutual fund, right scheme of mutual fund that will help you achieve your financial goals. One thing that is essential while you choose the right mutual fund scheme is to look at the details of the mutual fund, like the fund house, the history of the fund house, for how long has it been operational, what are the results that the mutual fund schemes of that particular fund house have generally declared, who is the fund manager, what is his track record. All these details need to be studied. Is there, how does the website look? What are the declarations that are there on a website? Now, one example that I want to give you is Navi Mutual Fund, which is a relatively new mutual fund. If you go to their website and check for statutory declarations which are mandatory as per SEBI, that page itself, you cannot see anything on it. The page is blank. Now, Navi Mutual Fund was started by Sachin Bansal of Flipkart. So it's not that the founder of the mutual fund is an unknown person or he doesn't have a good track record. But abiding by the statutory regulations that are put forth by the regulator is very much necessary, and you as an investor should be aware about how a mutual fund is following the rules that are laid down for them to be able to operate in the market, right? So all these things are very necessary. One more important factor that you should keep in mind is to look at diversification in your portfolio. It is a very common saying that you should not put all your eggs in one basket, right? Likewise, in our investments also, our investments should not be concentrated only in one particular type of investment, like say a bank FD or investment in real estate or investment in shares. All and sundry should be part and parcel of our portfolio. Why? Because the returns that you expect from each of these types of investment is different. The time horizon for which you can invest money in such various investments is also different. Also, the liquidity factor. How soon can you convert these investments into cash if you need the same is also to be taken into consideration. So while choosing a mutual fund, looking at the details of the mutual fund, looking at the kind of scheme with your duration and risk profile in mind, as well as diversity in your mutual fund, will make a healthy portfolio of investments for you. The third important step for you to start investing in a mutual fund is to have your KYC process done. Now, KYC, know your customer, is a mandatory regulation passed by the government wherein all investors have to undertake that. We do that for our bank accounts. Likewise, you will have to do that while investing in a mutual fund. Now, this process basically asks for your PAN details and your address proof. KYC can be done online as well, but physical verification is a must as per SEBI guidelines. Why is KYC necessary? It is necessary because to keep a track rather of the source of your funds. Where did you get those funds from? And to do away with any money laundering or fake transactions, black money transactions that occur in our system. So it is a very important step for all investors when you decide to invest in a mutual fund. The next important step is normally having a net banking account. Now, all of us have bank accounts, we have checkbooks and we have debit cards issued for our bank accounts. But having a net banking account password for your bank account comes in handy if you have to do online transactions or if you have to invest in mutual funds directly without going through a middleman or a mutual fund distributor. So, opening a net banking account is of convenience to you as an investor. Next step, if you are new to investing in a mutual fund and you don't know which mutual fund is suitable for you, even after a lot of deliberations, one thing that you should do is you should approach a mutual fund distributor or an investment advisor. Now, these are SEBI registered agents and AMFI registered distributors who are able to sell mutual funds, who are able to distribute mutual funds on behalf of the mutual fund houses. Taking advice from an investment advisor is worthwhile the fee that you pay to the advisor. It's like going to a doctor in case you want a prescription for a particular medicine. Googling something and taking a medicine, the kind of risk that is involved in that, the same kind of risk is studying the particular investment options available and investing in them. So if you are not completely sure about which investments to make and what schemes to decide, taking the services of a well-known investment advisor comes in handy any day. You can ask for recommendations from your friends and family. You can look at the track records of the investment advisor, and you can approach people who will give you the right advice and help you increase your wealth. Once all these steps are sorted, there are two ways in which you can invest in a mutual fund. Either you can directly approach the fund house, ask for a form for a particular mutual fund, draw a check or pay by card and invest by a direct plan, direct option, directly to the mutual fund house. There is another way wherein you can approach a mutual fund distributor and opt for a regular plan. In this second option, what happens is the mutual fund house pays commission to the distributor who is investing, who is helping you invest in that particular scheme. You can also invest online if you have net banking passwords, net banking options, I'm sorry. So it is not mandatory to have net banking credentials, but it always is of convenience if you have it. So two ways where you can invest in mutual funds: directly approaching the mutual fund house and investing directly into any particular scheme of a mutual fund, or going through a mutual fund distributor and investing through a regular plan. So these are the two ways in which you can invest in mutual funds. Alternatively, what you can do is, if you are opting for an online investment, you can go to the websites of individual mutual fund houses and you can pay via your net banking or cards that you have for your account, and you can directly invest in schemes of mutual funds without going through the hard copy of the forms and going through online websites. So there are multiple ways in which you can transact in mutual funds. Now, do you need a demat account for holding mutual fund investments? Again, it is optional. It is not mandatory like shares to hold a demat account. Mutual funds can be purchased even if you do not have a demat account. If you are investing in mutual funds through online trading platforms like, say, ICICI or the HDFC one, wherein there is an option to buy mutual funds, the units of those mutual funds will get credited in your demat accounts, not otherwise. So having a demat account is also not a mandatory requirement for investing in a mutual fund. So having followed all these steps, right from putting your financial goal in place, to deciding on which mutual fund and which scheme of that particular mutual fund, to knowing details of the mutual fund, the fund manager, etc., knowing what diversification can do to your portfolio and where you wish to diversify your investment, doing your KYC, opening a net banking account for your bank account, then approaching a investment advisor if you are unsure about the kind of mutual funds you want to invest in, and you are all set to make your first investment in a mutual fund. Now, if you are still skeptical about how the mutual fund works and you don't know what kind of returns to expect and how communication will be between you as an investor and the mutual fund house, one simplest way to start investing in a mutual fund is by starting a SIP, systematic investment plan, because you can start a SIP with as low as 500 rupees. So not much amount is involved, and you will get, over a period of time, you will get an understanding about the working and the kind of communication and the returns that you can expect from the fund house. Once you are comfortable with investing through an SIP in a mutual fund, you can think of lump sum investments in various other kinds of schemes of mutual funds. So the easiest, the most convenient and professionally managed investment in today's times, which can give you returns that match the stock market investments but with lower risks. Mutual funds should definitely be a part of your investment portfolio. Don't overlook it, don't ignore it because you don't know about it. I am here to help you understand better why mutual funds are a superior option to most of the investments available in the market today. Ask me any queries if you have about mutual funds and your investments, and I will definitely help you to resolve them. Thank you. If you have liked my video, please like and subscribe and share my video to reach as many people as possible. And see you tomorrow with another video with some value addition in your investment journey. Thank you.